Ever wondered how a company that, rents out big stuff like buildings or equipment or even trucks actually records all that? It's definitely not as simple as just jotting down rent income.
Not at all. It's surprisingly complex behind the scenes.
Yeah, so today we're doing a deep dive into exactly that. We're focusing on the lessors, the companies doing the renting out, and how they figure out, well, how to account for these leases.
Exactly. We're pulling from, core accounting and finance principles here, really focusing on the nitty-gritty criteria and how they actually apply these rules in practice.
And our goal, simple, cut through the jargon. We want to give you a really clear, solid understanding of how these transactions work.
So you can walk away feeling like you've actually got a handle on it.
Okay, so let's start big picture. From the lessor side, what exactly is a lease?
Fundamentally, it's about transferring control.
Yeah.
The accounting standards talk about transferring substantially all the benefits and risks inherent in ownership of property from the lessor to the lessee, the one doing the renting.
Substantially all the benefits and risks. Okay, so what does that actually mean for the accounting?
Well, it often means it's treated less like a simple rental and more like an installment purchase, just, structured as a lease.
Okay, so it's the substance over the form.
Precisely. And because of that substance, a lessor has to classify each lease into one of three main buckets.
3 buckets.
Yep. It could be an operating lease, which is closer to a true rental, or it can be a finance lease. And for lessors, there are actually 2 types of finance leases: a sales-type lease and a direct financing lease.
Okay, operating, sales type, direct financing.
Yeah.
And deciding which bucket it falls into. That comes down to control again, right? Whether the lessee basically takes control of the asset.
That's the core question, yes. Does the lessee, in effect, assume control? Answering that determines everything else.
So how do they answer that? Is there like a checklist?
There is. It's a specific set of criteria they run through at the start of the lease. And thankfully, there's a handy acronym to remember them: OWN NSPC.
Own SPC. Okay, I like mnemonics. So walk us through onus first.
Right. So if the lease meets any one of the 5 OWN criteria, it's generally classified as a sales-type lease for the lessor.
Just one. Okay, what are they?
First, ownership. Does ownership of the asset transfer to the lessee by the end of the lease? Pretty straightforward.
Okay, makes sense.
Second, written purchase option. Does the lessee have an option to buy the asset, and are they reasonably certain to actually use that option?
Reasonably certain. Okay. A bit of judgment there.
A little bit, yeah.
Oh.
Third, net present value. This is a big one. You calculate the present value of all the lease payments plus any residual value the lessee guarantees. If that total equals or exceeds substantially all of the asset's fair value.
Substantially all meaning?
Generally accepted as 90% or more. So if the PV covers 90% or more of the fair value, that triggers it.
Got it. 90%. What's next?
Fourth, major part of economic life. Does the lease term cover the major part of the asset's remaining useful economic life? Usually people think around 75% or more for this one.
Okay, 75% of the life. And the last one, S.
Specialized nature. Is the asset so specialized that the lessor won't really have another use for it when the lease ends? Think like custom-built machinery for one specific factory.
Okay, so if it's basically useless to the lessor afterwards. So if any of those 5, ownership, written option, net present value, major part of life, or specialized nature, if any onus criterion is met, boom, sales type lease.
Exactly. It signals that the economic reality is much closer to a sale than a rental.
Okay. But what if none of the onus criteria are met? Then what, is it automatically an operating lease?
Not quite yet. That's where the PC part of OWN PC comes in. If none of OWNs are met, you then look at 2 more criteria.
Okay, PC, what do they stand for?
Right. If both P and C are met, then it's classified as a direct financing lease. If only one or neither is met, then it defaults to an operating lease.
Both P and C. Got it. So what's P?
Present value again, but slightly different calculation. Here you look at the present value of the sum of the lease payments, any lessee guaranteed residual value, and any third-party guaranteed residual value. Does that total equal or substantially exceed the asset's fair value?
Okay. Similar to the N test, but includes third-party guarantees too. And C.
Collection probable. Is it probable that the lessor will actually collect the lease payments and any amounts needed to cover those residual value guarantees?
Okay, so just assessing the credit risk, essentially.
Pretty much. So P is the PV test, C is the collection test. Both must be met for it to be direct financing.
Right. Let's recap that decision tree then, just to make it super clear for everyone.
Good idea.
First, check owns. If any onus criterion is met, sales type lease.
Correct.
If none of the onus criteria are met, then check PC. If both P and C are met, direct financing lease.
Yep.
And if none of the onus are met and you don't meet both P and C, so you meet zero or one of them, operating lease.
That's the logic exactly. It's a sequential process.
Perfect. And for all those present value calculations, what interest rate does the lessor use?
They use the rate implicit in the lease. That's basically the interest rate that makes the present value of the payments and the residual value equal the asset's fair value at the start.
Got it. Okay, so classification is key. Now let's dig into how the accounting actually changes based on that classification. Sales type first.
Makes sense. So for a sales type lease, remember the core idea. The lessee gains control. So the lessor treats it like a sale.
Meaning the asset comes off their books?
Exactly. On day one, the lessor derecognizes the asset, takes it off the balance sheet. They record a net investment in the lease, which is essentially a receivable. And assuming collectability is probable, they recognize profit or loss immediately.
Wow, okay. Profit hits right away.
Yep. Unless collection isn't probable, then the payments received are treated more like deposits as a liability. But assuming it is probable, the basic entry is debit lease receivable, credit the asset removing it, and credit gain or debit loss.
What about costs incurred to set up the lease, like legal fees or commissions? Initial direct costs.
Good question. If there is a profit or loss recognized immediately on that sale, then those initial direct costs are just expensed right away in the same period.
Okay.
If for some reason there's no profit or loss at commencement, then you defer those costs and amortize them over the lease term. But usually, with a sales type, there's a gain, so they get expensed.
And then period by period as payments come in.
The lessor recognizes interest income. You take the beginning balance of the lease receivable and multiply it by that implicit interest rate.
Just like interest on a loan.
Exactly. So when the payment comes in, part of it is recorded as interest income, and the rest reduces the principal balance of the lease receivable.
Okay, let's make this concrete. Example time. Say, Jenkins Inc. leases a truck to Briggs Co. It's a 4-year lease. Payments are $5,000 a year, paid at the end of each year. Jenkins had $450 in initial direct costs. The implicit rate is 6%. Let's say the lease starts Jan 1, year 2. On that date, the truck's carrying value on Jenkins' books is $22,000, but its fair value is $24,216. And Briggs, the lessee, guarantees a residual value of $8,700. Collection is probable. What are the entries for Jenkins on Jan 1, year 2, and DeSec year 31, year 2?
Okay, step 1 on Jan 1, year 2. Calculate the lease receivable. It's the present value of those $4,000 or $5,000 payments at 6%, plus the present value of the $8,700 guaranteed residual value at 6%. You run the numbers, and that adds up to $24,216.
Which conveniently matches the fair value.
It does. So the lease receivable is $24,216. The carrying value of the truck was $22,000. So Jenkins has a gain on the sale of $2,216.
Okay, so what's the journal entry look like?
Jenkins would debit lease receivable for $24,216. They'd credit the truck asset for $22,000 to remove it. They'd credit gain on sale for $2,260. Yeah. And since there's a gain, they expense the initial direct costs immediately. Debit lease expense for $450 and credit cash for $450.
Got it. Asset off, receivable on, gain recognized, costs expense. That's lease commencement. Now, end of the year, DEX 31, year 2, first payment comes in.
Right. First, calculate interest income for the year. Take the beginning receivable balance, $24,216, and multiply by the implicit rate, 6%. That's $1,453 of interest income.
Okay.
Briggs pays $5,000 cash. So Jenkins debits cash for $5,000. They credit interest income for $453. The difference, $3,547, reduces the receivable balance. So credit lease receivable for $3,547.
Perfect. And that process just continues each year, right? The receivable balance goes down. The interest income calculation changes each year based on the new lower balance.
Exactly. Until at the end of the lease, the remaining receivable balance should equal that $8,700 guaranteed residual value.
Makes sense. Okay, that's sales type. Now, what about direct financing leases? How are they different? Remember, these are the ones where ONIS wasn't met, but both P and C were met.
The big difference here is control the lessee doesn't gain control, like in a sales-type lease. But it's still seen as a financing arrangement by the lessor.
So, asset still comes off the books?
Yes. The lessor still derecognizes the asset and recognizes a net investment in the lease, similar to the sales type. But here's the crucial difference. Any gain on the transaction is deferred. It's not recognized immediately.
Deferred, so it doesn't hit the income statement right away?
Correct. It gets spread out, amortized over the lease term, usually as an adjustment to the interest income recognized each period. Only losses get recognized immediately.
Wow. So comparing two lessors, one using sales type and one using direct financing for similar deals, their reported profit could look very different in year one, couldn't it?
Hugely different. The sales type lessor looks more profitable up front. The direct financing lessor smooths that profit out over time. It's a really important distinction for analysts.
Definitely. And what about initial direct costs in a direct financing lease?
For these, they're always deferred and amortized over the lease term. They get added to the net investment in the lease and increase the effective interest earned.
Always deferred.
Okay.
And ongoing accounting, still recognizing interest income.
Yes, still using the interest method, you apply a discount rate to the net investment in the lease to calculate interest income each period.
Okay, let's use that Jenkins truck example again, but tweak it slightly to make it a direct financing lease. Same facts mostly. 4 years, 5,000-year payments, end of year, 6% implicit rate initially considered. Jan 1, year 2 start, carrying value $22,000, fair value $24,216. But this time, instead of the lessee guaranteeing the residual value, Jenkins, the lessor, contracts with a third party to guarantee the $8,700 residual value. Let's assume this structure means it fails owns us but passes PC. How does Jenkins account for this now?
Okay, Jan 1, year 2, lease inception. Because it's direct financing, the gain is deferred. The lessor records the net investment in the lease equal to the carrying amount of the asset, which is $22,000.
So the receivable is recorded at $22,000, not the $24,260 fair value.
The net investment is recorded at $22,000. So the entry is debit lease receivable, net for $22,000, and credit truck for $22,000. That potential gain of $2,216 is basically embedded in the difference between the payment's residual and this initial net investment.
Oh, wow.
And here's a key point. Because that gain is deferred, the original 6% implicit rate isn't the right rate anymore for recognizing income going forward. The lessor has to calculate a new effective interest rate. This new rate is the one that equates the $22,000 initial net investment to the present value of the $4,000 or $5,000 payments and the $8,700 guaranteed residual value. In this specific example, that rate works out to be about 9.63%.
Whoa. Okay, so they back into a higher effective interest rate that essentially bakes in the deferred profit over the lease term.
That's clever.
It is. It ensures the deferred gain is recognized systematically as interest income over the 4 years.
So December 31, year 2, first payment comes in. How does the interest work now?
Yeah.
Use that new rate. Take the beginning net investment, $22,000, and multiply by 9.63%. That gives you interest income of about 2,119 deals.
Okay.
Jenkins receives the $5,000 cash payment. So debit cash, $5,000. Credit interest income, $2,119. And the remainder, $2,881, reduces the net lease receivable. Credit lease receivable, net $2,881.
Got it. So the mechanics are similar: cash in, interest income recognized, receivable reduced. But the initial setup and the interest rate used are fundamentally different because the gain is deferred.
Precisely. And again, you'd have an amortization table showing that net investment decreasing over time down to the residual value using that higher effective interest rate.
Fascinating how that deferral changes the game. Okay, one category left, the operating lease. This was the default, right? If it's not sales type or direct financing.
That's the one.
Yeah.
And the key here is simple. The lessor keeps the asset on their balance sheet. Control never really transfers in substance.
So the truck, in our example, would just stay listed under Jenkins property, plant, and equipment?
Exactly. They wouldn't derecognize it. Because they still own it, they continue to depreciate it over its useful life, just like any other fixed asset. They'd also check it for impairment if needed.
And the payments they receive.
That's just recognized as lease income or rental income, usually on a straight-line basis over the lease term. Even if payments vary, the income recognition is typically smooth.
Straight line income.
Okay.
And initial direct costs.
Also deferred and amortized over the lease term, usually straight line, matching the income recognition.
So the journal entries for an operating lease would look more like debit cash when payment is received, credit rental income, and then separately debit depreciation expense, credit accumulated depreciation for the asset itself.
That's basically it. Much simpler in many ways because you're just treating it like you own an asset and you're renting it out.
Okay, that covers the 3 main types. Now let's shift gears slightly to something you mentioned earlier, sale-leasebacks. These sound potentially complicated.
They can be. A sale-leaseback is when a company sells an asset they own to someone else and then immediately leases that same asset right back.
So the original owner sells it but keeps using it.
Exactly. The seller becomes the lessee and the buyer becomes the lessor.
Why would companies do this? Unlocking capital tied up in assets?
That's often a primary driver, yes. But the accounting hinges on whether that initial sale part of the transaction actually qualifies as a real sale under revenue recognition rules.
Ah, back to the substance. Has control truly transferred?
Precisely. There needs to be a valid contract, and control needs to genuinely pass from the seller lessee to the buyer lessee. If it doesn't meet those criteria, the whole thing is treated not as a sale and leaseback, but just as a financing transaction, like a loan.
Okay. What kind of things might prevent it from qualifying as a sale? What makes that control transfer questionable?
Two common situations trip this up. First, if the seller lessee has a repurchase option.
An option to buy it back later.
Yes. For the sale to be valid, that repurchase option price needs to be the asset's fair value at the time it's repurchased. And crucially, there need to be other similar assets readily available in the market. If the option price is fixed or below market, or if the asset is unique, it usually fails the sale criteria.
Because it suggests the seller never really gave up control if they can just easily get it back cheaply or if it's one of a kind.
Exactly. The second situation is a significant residual value guarantee provided by the seller lessee.
So the seller guarantees what the asset will be worth at the end of the leaseback.
Yes. If that guarantee is so large that the seller lessee retains substantial risk of ownership, it again makes it look like control didn't truly transfer to the buyer lessor. This one's more of a qualitative judgment call.
Okay, so repurchase options and residual value guarantees are red flags for whether a sale actually happened. Let's assume for a moment that the sale criteria are met. It qualifies as a real sale. What happens next?
Then, both parties need to figure out if the transaction happened at fair value. Assuming they aren't related parties, this is important.
How do they check if it's fair value?
It's a two-step comparison.
Yeah.
First, figure out which pair of values is easier to determine. Is it pair 1, the asset's sale price and its actual fair market value, or pair 2, the present value of the leaseback payments and the present value of what market rental payments would be for a similar lease?
Okay, pick the more reliable data set. Then what?
Then you compare the two numbers within that chosen set. Is the sale price different from the fair value? Or is the PV of lease payments different from the PV of market rents?
And if there is a difference?
That difference needs to be accounted for separately. If the sale price is higher than fair value, or PV of payments is higher than PV of market rents, that excess is treated as additional financing provided by the buyer lessor to the seller lessee. It gets recorded as a financial liability by the seller lessee.
So the seller got extra cash up front, treated like a loan. What if it's the other way? Sale price lower than fair value.
If the sale price is lower than fair value, or PV payments lower than market, that difference is treated as prepaid rent by the seller lessee. It's like they got a discount on the sale in exchange for higher rent later, so they record it as an adjustment to their right-of-use asset for the leaseback.
Okay, that adjustment mechanism makes sense. Let's try an example. Billings Co. owns equipment. Original cost $500, accumulated depreciation $85K, so carrying value is $415, remaining life 10 years. On Jan 1, year 3, Billings sells it to Crane Inc. for $490K as cash. But the actual fair market value of the equipment on that date is only $470K. Crane immediately leases it back to Billings for 5 years. Payments are $112,396.50 per year, starting Jan 1, year 4. Implicit rate is 4.75%. Let's assume this does meet the criteria to be a sale. What's Billings' seller lessee's journal entry at the time of transfer?
Okay, first we compare the sale price, $490K, and the fair value, $470K. Those seem readily determinable.
Right, and the sale price is $20 higher than the fair value.
Exactly. So that $20,000 difference is treated as additional financing provided by Crane, buyer lessor, to Billings, seller lessee. Billings will record this as a financing liability.
Okay, so what's the full entry for Billings?
Billings gets cash, so debit cash, $490,000. They need to remove the asset and its depreciation. Debit accumulated depreciation, $85,000. Credit equipment, $500,000. They record the financing component. Credit financing liability, $20,000. The balancing figure of the gain on the sale. That would be $490K cash, $20K financing, $415K carrying value. So credit gain on equipment sale, $55,000.
Wow, okay. So the gain calculation is adjusted for that financing piece. That's critical.
It is. One more very important point here. For Billings to even recognize that $55,000 gain, the leaseback portion must qualify as an operating lease for them, as the lessee. If the leaseback met the criteria to be a finance lease for Billings, meaning they essentially regain control through the lease, then the whole transaction is deemed a failed sale. even if it passed the initial sale criteria. If the leaseback gives back too much control, no gain or loss is recognized on the initial transfer. It all reverts back to being treated as a financing.
Fascinating. So the nature of the leaseback itself can retroactively kill the sale treatment. Okay, what if it is a failed sale from the start? Say the repurchase option was weird or the residual guarantee was too big. The criteria for a sale are not met.
Then it's simple. Both parties treat it purely as a financing transaction. The seller, lessee, never takes the asset off their books. The buyer, lessor, never puts it on their books.
So the seller just records the cash they received as debt?
Exactly. The seller lessee records the financing liability for the cash received. The buyer lessor records a financing receivable for the cash paid out.
Let's use that billings example again. Same facts, 490K cash received, but assume it fails the sale criteria. What does billings record on Jan 1, year 3? And then what happens at the end of the year, Dec 31, year 3?
Okay. Jan 1, year 3, at inception, billings gets the cash and records the debt. Debit cash, $490,000. Credit financing liability, $490,000. That's it. The equipment stays on their books untouched.
Simple enough. Now, end of the year, Detang 31, year 3. No lease payments have started yet in this example, but what does billings need to record?
Well, they have the financing liability, so they need to accrue interest expense. That'd be $490,000 liability, 4.75% rate, equal $23,275. So debit interest expense, $23,275. Credit financing liability, $23,275, increasing the debt.
Okay, interest expense. And what about the equipment?
Since it never left their books, they continued to depreciate it as normal. The carrying value was $415 with 10 years remaining life. So annual depreciation is $41,500. Debit depreciation expense, $41,500. Credit accumulated depreciation, $41,500.
Got it. So in a failed sale leaseback, the seller just keeps depreciating the asset and treats the cash received like a loan accruing interest. The buyer just treats it like a loan receivable.
That's the essence of it. The leaseback payments, when they start, are treated simply as debt service, part interest, part principal repayment.
Phew, okay. That covers a lot of ground on classification and accounting. How does all this actually look on the financial statements for the lessor?
Good question.
Huh?
On the balance sheet, if the lessor has sales type or direct financing leases, they have to show their net investment in leases separately from other assets like regular property, plant, and equipment.
So you can clearly see the assets tied up in these financing type arrangements.
Exactly. But for operating leases, the lessor just keeps showing the underlying assets within their normal PP&E categories because they still own them.
And on the income statement?
Lessors have to disclose their lease income. They might have a separate line item for it, or they'll disclose in the notes how much income is included in other lines, like revenue or other income. You'll see interest income from the finance leases and rental income from the operating leases.
Okay. And speaking of notes, disclosures are a huge part of this too, right? Giving users more context.
Absolutely crucial. There are extensive disclosure requirements. Qualitatively, lessors need to describe their leasing arrangements, talk about any options to extend, terminate, or purchase, mention any significant judgments they made, like figuring out if something is a lease or allocating contract value, and discuss any related party leases and their general accounting policies.
Gives you the story behind the numbers. What about quantitative disclosures? The actual numbers?
Lots there too. They need to show the profit or loss recognized at commencement for sales-type leases, the total interest income from finance leases, the income from operating lease payments, income from any variable payments not in the main calculation. They also have to break down the components of that net investment in sales-type and direct financing leases, show the receivable, the unguaranteed residual asset, any deferred profit, etc.
A lot of detail.
Yes, and information about the assets under operating leases, like their carrying amounts and depreciation. And importantly, a maturity analysis.
Maturity analysis.
Yeah, showing the undiscounted cash flows they expect to receive from their lease receivables year by year for the next 5 years, and then a total for all years after that. It helps users understand the timing of future cash inflows.
That maturity analysis sounds incredibly useful for forecasting. Okay, so we've gone from classifying leases with OwnSPC through the different accounting for sales type, direct financing, and operating leases, and even tackled the twists of sale-leasebacks. It really underscores how vital it is to look past the label and understand the economic substance ownership versus use.
It really does. This deep dive, I think, really highlights how accounting isn't just, bean counting. It's about interpreting the true substance of a deal, which makes you wonder, what other common business agreements might have a surprising substance hidden beneath the surface if you really dug into the accounting?
That is a great question to leave folks with. What other seemingly simple transactions might have these kinds of intricate rules? Understanding these details can definitely give you an edge when you're trying to figure out what's really going on inside a company's finances.